Hey everyone, welcome back to Corporate Decoder, the place where we try to spot the tiny details that make or break a company. Today we're diving into a filing from Hennessy Capital Investment Corp, the VIII, and let's just say there are some interesting moves happening as they prepare for what is next. It is all about their initial public offering or IPO and the agreements that came with it. Before we jump in, if you like decoding the financial world, make sure you are subscribed. And hey, we've got a fantastic community over on Discord, link in the description below, where we break down these filings even further. So what is the big news here? Hennessy Capital Investment Corp, the VIII, or HCQ as it is also known, has just completed its initial public offering. Think of this as the moment a private company decides to sell shares to the public for the very first time. They sold a whopping 24.15 million units, and each unit was a package deal. One ordinary share and one right to get a fraction of another share later on. They're calling these share rights. The price was set at $10 per unit, raking in a substantial $241.5 million before any costs. This is a pretty standard way for investment companies like this to get off the ground, setting the stage for them to acquire another business down the line. Now, to make this IPO happen, a bunch of important agreements were signed. First up, there is the underwriting agreement. This is basically the contract with the investment banks like Barclays Capital Inc. and Cohen & Company Capital Markets, who helped sell these shares to the public. They act as the middlemen, making sure everything goes smoothly and the shares find buyers. It is a critical piece of the puzzle for any IPO. Then we have the share rights agreement with Odyssey Transfer and Trust Company. This lays out the rules for those share rights we talked about. Remember, these rights give holders the chance to get a piece of a Class A ordinary share later, usually after the company finds and merges with another business. There is also a letter agreement involving the company, its officers, directors, and the sponsor, HC the VIII sponsor LLC. This agreement likely covers important commitments and understandings between these key players, especially concerning the structure and management of the company during this transition phase. Crucially, there is an investment management trust agreement with Odyssey acting as the trustee. This is where the money raised from the IPO goes. A significant chunk, around $241.5 million, is deposited into a trust account. This money is earmarked for future use, typically to fund the acquisition of the target business. It is a way to protect the investor's money until the company's main objective is achieved. We also see a registration rights agreement. This gives certain stakeholders, including the sponsor and other security holders, the right to have their shares registered with the Securities and Exchange Commission, or SEC, allowing them to be sold to the public more easily down the road. And an interesting one, a private placement units purchase agreement. This is where the company's sponsor, HC the VIII sponsor LLC, bought an additional 671,000 units, known as private placement units, for $10 each, bringing in another $6.71 million. These units are similar to the ones sold to the public, but with some key differences. Mainly restrictions on when they can be sold. This shows the sponsor's continued commitment and investment in the company. Now, on top of all these agreements, the company also announced the pricing of its IPO through a press release. This is standard procedure, letting the world know the deal is set. And then, just a couple of days later, on the 6th of February, they officially announced the closing of the IPO, meaning the shares are now out there in the hands of public investors. An IPO isn't just about money, it's also about leadership. In connection with this IPO, several new directors were appointed to the board. Brian Bonner, Kyle Crowley, Javier Sadi, Sandra Stash, and Elizabeth Williams have all joined. Some of them have also taken on important roles on committees, like the Audit Committee and the Compensation Committee. This reshuffle often happens as a company goes public to ensure it has the right governance structure in place. They've also entered into those letter agreements and indemnity agreements, meaning the company will help protect them if they face any legal issues related to their roles. Interestingly, before all this, in January, the sponsor transferred some Class B ordinary shares to these new directors. This is a way to align their interests with the long-term success of the company, often at the same price the sponsor originally paid. It is a common practice to show a unified front and a commitment to the company's future. Something else that happened around this time was the filing of the company's amended and restated memorandum and articles of association. This is essentially the company's constitutional document outlining its rules and structure. When a company goes public, these documents often need to be updated to reflect the new requirements and expectations of being a publicly traded entity, especially when it is incorporated in a place like the Cayman Islands. Let's circle back to that money. The filing makes it clear that a total of $241.5 million from the IPO and the private placement units has been put into that segregated trust account. This account is managed by Odyssey, and the money is there to fund the company's search for a business to combine with. The funds won't be released until a business combination is completed. or under specific circumstances like a shareholder vote to change redemption rights, or if the company fails to find a business partner within a set time frame. This timeline is usually around 24 months. So, what is the takeaway from all this? Hennessy Capital Investment Corp, VIII, has successfully launched itself into the public market. The IPO is a major milestone, bringing in significant capital and setting the stage for its future acquisition plans. The flurry of agreements signed shows a well-structured approach to this transition, with clear roles and responsibilities outlined for the company, its sponsors, directors, and underwriters. The money raised is safely tucked away in a trust account, ready to be deployed for its intended purpose. The appointment of new directors also signals a strengthening of the governance framework. Looking at the bigger picture, this filing is really about the potential of Hennessy Capital Investment Corp, VIII. They've done the hard part of going public and raising money. Now, the real challenge begins: finding the right business to combine with and delivering value to their shareholders. The success of this venture will hinge on the management team's ability to identify and execute a strong acquisition strategy. The risks are that they might not find a suitable target, or that the chosen acquisition doesn't perform as expected. However, the setup here, with the funds secured and a clear timeline, provides a defined path forward. It is a classic SPAC or special purpose acquisition company maneuver, and we'll be watching closely to see what business they decide to bring into the public spotlight through this vehicle. Alright, that is our breakdown of Hennessy Capital Investment Corp, VIII's latest filing. What is your take on these moves and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.